The month of October witnessed a near 8 to 10% correction on all indexes, and since stocks are typically 2.5 to 3 times the beta of the index, individual stocks could have corrected by almost 25 to 30% in the same period. This has obviously led to notional losses in the portfolios of many investors, and in some cases, in the case of traders, it would have also led to realized losses in the particular period if they had a long only strategy. The reason for long only strategy would obviously be that the last time Nifty closed decisively in red was October 2023, and since then it has traded 12 calendar months in with a green closing. There have been certain dojis in between, but by and large, month on month, the market has closed in green. And therefore, when the market continues a particular direction for a very long time, it becomes a natural response of the traders to follow what the markets have previously been doing. And since in the past the traders have been rewarded in buying the dip, it is logical that the correction on the market would have invited more participation from these traders. But only this time the market did not close the month in a green. Instead, it chose to close in a red, and by almost 10%. However, a single red candlestick does not change the nature of the trend, and therefore, for anyone who is investing in the markets, this is the trend has not changed, and therefore the plan of investing should continue as is. And for traders in general who are investing in the market, they will need to follow the price action on the shorter time frame in order to determine whether or not they should buy, and if they should, then what should be the plan of exit. After having seen the time frame on the monthly, once we move to the weekly charts, we can clearly see that the market has in this recent fall created a double bottom. I have marked this with a black line here, and we can see that the low that the market had created, that which was a higher bottom at the time. So I will just edit this as a higher bottom, a low which the market had created in August of 24 was tested this time in October November 24, creating a double bottom. Now, when the market creates a double bottom, all positional traders will see that the market is in a range. The reason is very simple. We know that for a trend to exist, the market needs to create a higher bottom. But if at any point in time the market creates a double bottom, then the bias of the trend has shifted towards a range. Now, we also know that positional traders would be looking at the market on the weekly time frames, and such traders will find that the market is on the lower end of a particular range with a bias on the long side, and therefore such traders will wait for the market to become highly oversold, such as in the daily time frame, and wait for a confirmation in order to enter. So where the investors were seeing a higher top higher bottom unchallenged pattern, we can clearly see this is the higher bottom, and this in relation to the monthly charts is not the double bottom, but instead if the market takes a support here, this will be the higher bottom for the month or for the period. However, on the weekly, this structure changes, and this higher bottom is now replaced by a double bottom, and that is to say that the market has actually altered its trend structure on the weekly to a range with a long bias. And the plan to trade a range with a long bias is very simple, that whenever you have a ranging security, you want to trade in the direction of the oscillators. And it is obvious, since the market is at the lower point of the range, the oscillators on shorter time frame will be towards the oversold category, and logically this will invite traders to contest this or see if the market can actually take support of the low value of this range. So on the weekly time frames, we can see that the market has actually over the weeks, that is from this period, has changed its trend from a strong uptrend to a range with a long bias. And since the market in a single wave has changed its trend not only on the weekly but also on the daily, it would have logically altered the setups of many swing and positional traders who use daily and weekly time frames in order to establish the trend. Now let us see how the swing traders would be reviewing the market for now. And the swing traders would also see that the market has indeed come under a broader range, but when we narrow down, because the scope of the swing trader is going to be every pivotal high, here we have the double bottom which is relative to this particular low. So let us just follow this price action as we see it. We can see that from a higher top, the market has now indeed created a double bottom, and the reason to analyze this particular security so closely is because of the formation of an inside day candle. We know that an inside day candle is a potential bullish reversal candle, and all we need is a closing above the high of the candle in order to set its confirmation. Subsequently, in the trade sessions, we wait for the high of the inside day candle in order to take an entry, and whenever we would take the entry, it is reasonable to assume that the low of this candle, which is approximately 24,650, would be the stop loss from the point of entry. At this point here on the 14th of October, we can see a green closing above the high of this candle, and theoretically one could argue that the market has given a confirmation of an inside day candle. A trader who would have entered here at 25,000 would have necessarily had to keep a stop loss around 24,650 or 24,700. Subsequently, the market gapped up but failed to give a continuation move from the resistance point, a spinning top, a clear sell off, and the SL would have triggered. After the SL would have triggered, we can see that the market attempted to form a bullish piercing candle, and it is pretty much at the midpoint of the candle that was formed on the 17th of October. So I will label these here. So this is the inside day, and I will just try and connect it with an arrow. This is the inside day that I am talking about. This here is the confirmation which would have triggered the entry of a trader who is using the inside day as a confirmation to enter or to guess if the range low has been formed, because this is how he would have seen or she would have seen the chart at that point. Logically, we have the SL that got triggered at the black line which is mentioned here, which is 20. So I'll just mark this in another color, pink, which indicates that the SL would have triggered and that the trader would have taken a near 300 point loss on Nifty, which amounts to roughly 7,500 rupees on a lot. And after the SL triggered, or the day that the SL triggered, the market actually closed and formed or attempted to form a bullish piercing. So I will just write bullish piercing in two different rows in order to make it. Now logically, once the bullish piercing is formed, we know that the confirmation will happen on a close above 24,900, and whenever, if that were to happen, the SL would shift to 24,500, which is the low of that particular piercing candle. So we wait for the next day. This is not a confirmation, of course, because it's a red candle. It was a gap up. The momentum from the previous day did carry forward, but we didn't get a confirmation, and clearly the market, without confirming, continued with a move lower, and therefore we are still waiting in order to make an attempt at the bottom. The first attempt at the bottom, which would have traded on 14th of October, would have resulted in a loss somewhere around 18th of October. Now here, obviously, with the gap down and a small body close, the market has created a potential formation of a morning star, and in order, so this is the candle, the green candle that we can witness here, it is a potential star, and in order to make this a morning star, we would need a gap up green close clearly above the high of this candle, at which point, if this were to happen, the SL would shift the trade range would now shift from 24,600 to 23,350 levels. But instead of a gap up, we get a doji candle, which does not, which we can safely rule out. It is almost as if nothing really happened. And instead of a green close, we continue to get a red closing, thereby negating this star, and this is no longer a star pattern. And we continue with the assessment forward. And here we now get another inside day. So I will just simply copy this. We have another inside day on the market. Some could also correctly argue that this is a bullish harami. Alright. Now the only reason for a difference of opinion on whether it is a bullish harami or not is on the size of the candle. Some individuals believe that the size should be extremely small, whereas some should believe that it should be smaller than the previous candle. I will leave the interpretation open to the viewer. And of course, if this is indeed a bullish, an inside day or a bullish harami candle, we want a confirmation which is a clear close above this high of 24,500, at which point the SL would shift now to 24,000. We can see how with each passing day and how with each candlestick that the market has created, it gives us more information on what is the potential range of the market. And since the market corrected from 26,200, there has been one attempt at bottom picking and around 25,000 levels, which failed. Now we are waiting for the second attempt at bottom pick, and the only reason for doing that is because we are aware that the security is at least ranging with a long bias, if not trending on very long time frames, and it is currently in highly oversold conditions. The way to check highly oversold conditions would simply be to include any oscillator. For example, I will use RSI oscillator with a setting of 5, and we can see that around this phase the market is clearly oversold because the oscillator needs to be around the 30 zone, and we are now waiting for tactical bullish confirmations to make a trade plan. Subsequent day we do get a green closing, but it has not closed or traded above the high, and therefore we will just wait. The same thing the day after that, where it did not trade above the high of the candle, came pretty close, and therefore it is always useful to have some sort of a buffer, and a typical buffer is the average trading range, a factor of it, which would mean, for example, I can simply select the average trading range, and this is saying that the average trading range of the market is 270 points in a day. Now if the average trading range is 270 points, approximately a third of it would be 90 points, and a third of it is a reasonable buffer zone to keep. If we keep this buffer zone, which is approximately 90 to 100 points, we would also note that the buffer zone in this particular setup here, when the market had created a high of approximately 25,045, it would have needed the market to create a high of 25,145, which did get clipped here. So in other words, this trade was unavoidable. But in this particular trade, we can see that from a high of approximately 25,000, if we simply if we simply move it 24,500, if we simply move this till approximately 24,590, the probability of getting called in on a false break reduces significantly. And similarly, the SL2 could shift in such a case by the same factor, which is a third of the trading range. Now the question is, how do I establish a third of the trading range? In my trading experience, I have found that this is a reasonably safe buffer to keep. In other words, this is simply how I typically approach it. That's largely because if the market becomes highly volatile, the trading range changes accordingly, and it gives a good estimate of how much buffer one needs to keep. So having said that, after formation of the inside day or the bullish harami, we can see that the market had created a high of 25,000. We need the candle to be at 24,500, sorry. We need the candle to be at around 24,600, and we don't get it still. Now, this is obviously the Mura trading session, but as far as we are concerned, we will count this as a full trading session, and we can see that we get a very flat line doji. So this doji actually now, because of its position, uh, has a term for it, which is a doji bullish harami. So which is also a reversal candlestick, much like the bullish harami, but they all have varied strengths, and different traders have different preferences. So once again, with the doji bullish harami, we are looking for a clear confirmation, but instead of getting a confirmation, we have another spike lower, which means that this SL range will now shift lower, and all of this inside day harami, doji bullish harami, are negated simply because for them to be applicable, the market is not allowed to create a new low. If the market creates a new low, we have to repeat the process of finding reversal patterns again. And this is the trade session today. And in this trade session, we will see that once again the market has formed a bullish piercing. And if the market has formed a bullish piercing, so I'll just, for the purpose of aesthetics, bring this here. If the market has formed a bullish piercing, what is going to be our trade plan? We know that the high of the day is 24,230, which is somewhere here. We also know that the average trading range is approximately 280 points, and a third of it would be roughly 90 points or 93 points. So from this high of 24,230, I would simply move it approximately 90 points higher to 24,320. And at this point, if the market indeed trades at 24,330, I would assume during the trade session that the market has confirmed the bullish piercing. And if the market has confirmed the bullish piercing, I have a reference low prior to this, which is 23,816. And once again, I will move it approximately 93 points lower to 23,007, perhaps 23, somewhere here. So in other words, my entry on the long side of the market is conditional to a 90 point or thereabout from the current levels, approximately 150 points or thereabout up move, and at which point the trade would trade, and with the expectation that the low of 23,700 or 750 will not trigger. And the reason for all of this, the reason for attempting to go long, has been discussed. We have a market which is at the low of a range and is currently in a highly oversold conditions, and we are at the cusp of the US election. The markets will give its verdict to us latest by Friday, 7th of latest by 7th of January, that 7th of November, that would be Thursday. So the US would vote today, the counting would happen tomorrow, and perhaps in their later part of the day we would get the outflow, which would impact our trade session day after tomorrow. And because we are at the cusp of a very volatile event, it is good to be ready with a plan. Now the question is, what happens if the market gaps up, say 100 points, and continues to rally? Of course, my longs would get initiated, the longs that I would have planned for this space. And what if the market gaps down and trades below 23,730 or below this low of 23,800? Then of course this whole setup has been voided, and once again I have to wait for a series of bullish confirmation candles in order to estimate if we are at the potential low of a swing. So with this, I hope we have learned a few things about how to use candlesticks as a tool of capturing market psychology, and how to use candlesticks as a method for entering and trade planning. Once again, if the market does indeed gap up, the prediction is not that the market will go ahead and create a new high. The idea is that if the market does gap up, it is slightly more unlikely that it will trade below the pink line that has been marked here at approximately 23,740. With this information, I hope we have more insights towards the planning of the trade sessions ahead. I wish you all the best. Thank you.